So as you'll all remember from the last session, a disability trust, is an ideal vehicle to meet inheritance goals for a disabled child, either through a will or in a trust. And you may remember that funds held in a trust are generally seen as acceptable means of providing for your child with a disability. But most importantly, funds that are held in that trust are not treated as an asset by the person if they're receiving provincial disability benefits. And I think from the point moving forward of this presentation, when I talk about disability benefits, I'm really referring to provincial benefits that are available in British Columbia to individuals that meet certain criteria in terms of meeting the definition of what is considered a disabled person in British Columbia. And that's commonly referred to as disability benefits in British Columbia. So moving forward, what is a trust? And a trust is, for many, a very complex vehicle. But effectively what it is it's a relationship involving three distinct parties. We have the individual that creates the trust, or commonly known as the settlor, who gives assets to another individual, the second person, who we call the trustee. And that trustee has a fiduciary duty to hold and use those assets for the benefit of someone else, which we call the beneficiary. And that individual is typically our disabled beneficiary, and what we're going to really focus the presentation on tonight. So those are the three key elements of a trust, and the different players involving a trust. And Angela, I think you had an example.
Right. So I was going to say that if, for example, a mom gives or sets up a trust for her son, and she uses a friend of hers as the trustee, the mom is the settlor,
right.
The son is the beneficiary,
yes.
And the friend is taking on the trustee role, which is what we're going to talk about later.
Exactly. And
right.
So those distinct roles are really the foundation for the trust. And I think what's important, I guess, in the world of disability trusts is that we may have a trust that is in existence for many, many years. Your son or daughter may have a very long life. And we need to know that although we have the neighbor, the friend perhaps, that can take on that role, we need to be thinking beyond that friend. What if that individual cannot take on that role? What if that individual becomes incapacitated or passes on or just simply doesn't have the time or the energy? We need to have other potential trustees lined up and ready to move forward.
Right. Okay. Great.
So, and again, this is a refresher from the last session. There are various trust vehicles, and so we have the two types of trusts. We have the inter vivos, or living trusts, which is created by a person for his or her own benefit or by someone else during someone's lifetime, and we typically call those living trusts. And then the more common trust, which is the testamentary trust or the death trust. These are trusts that are created in a will or a trust when someone passes on. So the triggering element is the passing of someone. The key difference between these two trusts then is on how the trust was originally created and how the income in the trust is taxed. And I'll talk a little bit about taxation a little bit later in the presentation. But I think from the viewer's perspective, both of these trusts are seen as separate taxpayers. They breathe, they live, they pay taxes like you and I. So within those vehicles, we then have two types of trusts that from a disability perspective are commonly utilized. We have our non-discretionary and our discretionary trusts. And again, the key distinction between these two types of trusts is in terms of the power and control of the trustees, in terms of the management of the assets within that trust. So remember, power and control of trustees is really the distinguishing feature of these two trusts. The non-discretionary trust is actually a creature of regulation or policy. It is within the legislation, and it's permitted by the Ministry of Social Development. And this trust is a trust that the beneficiary themselves, so this is the individual with a disability, having some input, either because they are acting as a trustee or because they originally contributed assets to this trust. One key criteria of this trust, though, is that it is limited. There is only a permissible up to $200,000 in one of these non-discretionary trusts. There is some provision, again, for the ministry to provide an exemption beyond the $200,000, but for our purposes, there is a limit of $200,000. If an individual has funds exceeding $200,000 without exemption, those dollars would be deducted dollar for dollar from a person's provincial benefits. The other trust, and again the more common trust, is that discretionary trust. And these are trusts where the trustee has absolute control on how the assets are managed. The one key benefit of this trust is that there are no limits on the amount of funds within the trust, as compared to the non-discretionary trust, which has a limit of $200,000. So you can have millions of dollars in a discretionary trust, and your person with a disability will not lose their benefits. The other challenge, of course, with these trusts, and this is why we're really speaking about trustees tonight, is that with a discretionary trust, the beneficiary has no control. They are at the mercy of the trustee. They cannot demand that funds be expended from the trust. They must seek the discretion of that trustee in making disbursements. And if a trustee decides not to make that disbursement, then that is the law, unfortunately. Now, in British Columbia, discretionary trusts are probably more commonly used because in our province, in our lower mainland, many folks have assets that are going to exceed $200,000. And so a non-discretionary trust may not be the most optimum vehicle where you have an estate that is going to be substantially more. And so the discretionary trust is seen as a viable alternative, notwithstanding the lack of control that a beneficiary might have. So within that trust, whether it's non-discretionary, whether it's discretionary, there are permitted expenditures that can be made out of the trust. And many of these permitted expenditures are consistent with regulations within the province. And you'll see that there's a number of areas that funds can be dispersed from the trust for the benefit of that person with a disability. So the common vehicles of disbursement are devices or medical aids, caregiver services, education and training, renovation to the place of residence of that person with a disability, maintenance, and then any other item that promotes independence.
So with those expenses or expenditures, how would you draw on that? Would you draw monthly? Do you draw in a lump sum? And do those requests have to be, or those expenditures need to be in writing ahead of time?
Yeah.
Or can you just do it as you go, if it is, particularly if it's in a discretionary trust?
So again, with a discretionary trust, you're going to be really at the mercy of the trustee. And so you're going to want, and we're going to talk a little bit more later on about ways that we might design a trust to ensure some of those needs and requests are put forward, and a method for trustees and beneficiaries perhaps to work together. In terms of the permitted expenditures, all of the expenditures that I've just outlined have unlimited dollar amounts, and so there is no limit in terms of what you can use these funds for. So if you decide to spend, $100,000 out of the trust, that is permissible. Now, yes. Absolutely. So, and that's a great question. The question was, does a car or vehicle serve as a method of independence? And absolutely. I mean, one of the big changes around the independence clause, prior to December 1, 2015, there used to be a limit on what you could expend out of the trust fund annually, and it was capped at $8,000. But as of December 1, 2015, that exemption limit has now been distinguished, and it's now unlimited. So you can spend an unlimited amount of dollars. And what the ministry does in terms of determining what is independence, they look to the trustee. They don't tell you what is independence. It is between the trustee and the beneficiary to determine what is reasonable. And the ministry's belief is that only the trustee and the beneficiary know what is independence for that individual. Now, I should add, just on your question from the viewer, that a vehicle outside of the trust is also an exempt asset. And so from the standpoint of the ministry, if a person receiving PWD or persons with disability benefits receives a vehicle in their own name, that vehicle would not preclude them from receiving provincial benefits. Okay? So let's talk a little bit about the relationship between the ministry and a trust. And this is really important because as your trustee is administering these funds within the trust, it's absolutely vital that they understand what they can and cannot do. So in addition to those permitted expenditures, they also need to know how to disperse funds out of the trust itself. And one of the biggest misconceptions that trustees, I find, have is the distinction between earned and unearned income. And effectively what earned income is income that's earned from employment. So if your son or daughter has a job or a part-time job, they're able to earn employment income. However, if a trustee decides to disperse funds out of the trust fund directly to the beneficiary, the ministry sees that as what we call unearned income. And unearned income is any income that is not considered earned income. And so unearned income is actually deducted dollar for dollar from the benefits that an individual receiving disability benefits would receive. So it's absolutely vital, and I see this happen more and more, that a trustee not say to the beneficiary, look, I understand that you can receive earned income. I'm going to give you a salary out of the trust fund of X amount of dollars every month. That will eliminate provincial benefits by doing that. That will reduce the benefits. And so the trustee needs to understand that providing direct funds to the individual with a disability is not the most appropriate manner to deal with the trust fund. The appropriate approach is to transfer those funds not to the disabled beneficiary, but to third parties. So for example, your son or daughter with a disability would like to take a vacation, would like to go on a trip to Mexico. The trustee should not give the person with the disability $2,000. What they should do is they should write a check to the travel agent to arrange for the travel and potentially a caregiver to support that individual with a disability. That is an ideal method of disbursement, is that a trustee recognize that when you're making disbursements out of a trust, that those funds should be made indirectly for the benefit of that person with a disability. And that's going to maximize the use of those trust funds. And it's not going to impact those PWD benefits. The other important element, and I'm going to talk about taxation and the duties that we have to Revenue Canada, but it's important that we also understand that a trustee and a beneficiary has a duty to the ministry as well, where an individual is receiving PWD benefits. And so when the trustee is administering that trust, absolutely vital that they keep good records. They need to keep records of the money that's in the trust, how it's invested, how it's dispersed. There needs to be clear detail on what that trustee has classified as independence versus one of those other permitted expenditures, such as caregiver costs or medical equipment. Yeah, and we're going to talk about compensation a little bit later, so I might just ask you to hold on to that question. I promise you we will come to it a little bit later when I talk about compensation. Any other questions? So the trustee, as you can see, has a fairly extensive responsibility. They have a fiduciary duty to ensure that the oversight and the day-to-day management of that trust fund is managed prudently. So, when we're choosing a trustee, I think the first thing we need to recognize is that it is not an honor. It is a huge undertaking, a huge responsibility, and with that comes great liability as well. Trustees can be anybody, really, as long as they have capacity and they're of age. So it could be an individual, could be a professional, whether a person like myself, a lawyer, or an accountant, a financial institution, or a trust company, or some combination of both. Choosing a trustee, again, is an art, and it's really important that when you're choosing that trustee, you put your mind to the reality that, again, this trust could be in existence for many years. You might have a son or a daughter with a disability in their early 20s who might have a life into their 70s and 80s. So we're talking about a 50-year plus management of that trust. So we need to be able to think 50 years ahead, because when we're creating this trust today, while you're alive, you may not be here next week. And so it's important that when we're designing this trust, that we're taking steps to accommodate change. Succession planning is vital. So there are a number of criteria that we might look at in choosing a trustee. Obviously, the age of the beneficiary is vital. Is it someone that's 20? Is it someone that's 50? The age of the trustee. Is it reasonable to appoint grandma and grandpa? Maybe not. Maybe you need to appoint a friend, maybe a sister, a brother, maybe a sibling, and possibly a corporate trustee. How many trustees? There's really no magic answer here. It really depends on that family and what the needs are of that family. But we definitely want to have a provision for alternates. What if someone cannot act? Who will then act? What is the method of appointing that individual to act? And so these are really questions that are important also from the planning standpoint, not just from the administration point, ensuring that the trust enables succession, enables planning beyond our lifespan, into the time where your son or daughter may be much older and the trust is still necessary. It is absolutely vital in my mind as well that your trustee know and understand your son or daughter and understand their needs. And that is so important. I find that there needs to be a relationship as well. I think as parents, we have a good understanding of what the needs are of our son and daughter, and there's an expectation that our trustee should have a similar understanding. And it's not enough to simply be a trustee, but you also need to understand disability. You need to understand the complexity of the needs of that individual. What is their ambitions? What are their goals? How do we achieve those goals? How do we support those goals?
I was just going to ask in bullet point 3 where it says how many trustees should you have, that can you have more than one person share the role of a trustee at the same time?
Yeah, great question, Angela. So absolutely, we can have multiple trustees acting jointly. We can have single trustees acting alone. We can have alternate trustees. And we can have methods of appointing new trustees if there's a need for, let's say always having 3 trustees, always having 2 trustees. And this is where good planning will take into account some of these eventualities and ensure that, we're accommodating the what if. The what if needs to be planned today because we may not know what's happening 30 years from now. But we need to have a method, a system to actually enable that to actually happen.
So if you were to have more than one trustee, say a brother and a sister, sharing that role, when we go back to when you were talking about the discretionary trust and how the trustee has absolute control, would you put in writing or some sort of protocols around decision making should the trustees not agree on?
Yeah. So there's methods within the legislation to permit trustees if there is, let's say, uncertainty between trustees. So we may want to have, let's say, a method. And that's more common where we have 3 trustees. We might say the majority rules.
Right.
Or we may also have another method. We may have somebody that is appointed as a monitor. And the role of that monitor is simply to oversee the trustees. So this person is not actually a trustee, but actually someone that might be there to sort of observe and ensure that the trustee is acting prudently. And if they're not, we may have that monitor remove that trustee for lack of activity. So there are many mechanisms that could be utilized to provide some controls. And I think you bring up a really good point, Angela, that with that discretionary trust, because we're delegating control to the trustee, we want to have some mechanism to know that we're not going to have a rogue trustee out there operating without control. We need to put in some internal controls that will enable that trustee to function optimally. And I'm going to talk a little bit more about some of those things that we can do a little bit later here. But ensuring that your wishes are carried through to the best of our ability and balancing the need to ensure that the trust continues to be discretionary in the eyes of the ministry, while at the same time giving you some peace of mind knowing that your son or daughter is not going to be completely at the mercy of this individual. And 30 years from now, the trustee may not decide to disperse funds, or they might even more, negatively, they may decide never to disperse funds because they might be that ultimate beneficiary of that trust fund. And so there's an internal conflict.
Right.
So thinking about those issues, being aware of those issues early will assist us in ensuring that that plan is ideal, but also that we don't have a problem where your son or daughter ends up having to come to a lawyer one day to actually get some legal assistance because their trustee is not exercising discretion and not expending dollars out of the trust fund. And good planning on the trust will help significantly in reducing the problems later on.
There was a question came in online, but I actually think you're probably going to get to it later. So just want to acknowledge that the question came in, what happens to the trust when the beneficiary dies, if there's still funds in it? And you're getting to that later on.
I will get to that, yes.
Okay, so we will come back to that for sure.
So the other important thing about trustees is, again, and I think this goes without saying, they need to have an understanding of disability benefit, or as you see on the PowerPoint, the EAPDA, which is effectively the disability legislation that outlines what you can and cannot do with a trust. And so your trustee not only has to have those duties of and understanding of trust law, which is, as you can tell, a fairly big undertaking, but now they must also understand disability benefits. And so having somebody that understands that is vital. But I think it's also important that your trustee understand that if they do not have the answers, that they need to go out and get the answers. They need to get the advice. They need to go out and see someone that has expertise to ensure that they're not acting imprudently when they're managing that trust. So the other important element of the trust choosing, the choice of trustee, is residence of that trust. Where do they live? There are a number of reasons why this is important. Obviously, the practical one. If they live in China and your son or daughter is in Vancouver, is it practical? But more importantly, and this is from a tax standpoint, the residency of the trustee dictates and determines the residence of the trust. So if your trustees are resident in China, the trust will be deemed to be resident in China. And so you'll want to ensure that a majority of your trustees are resident in the province or the jurisdiction where you want that trust to be resident. So a lot of folks will have issues with U.S. residency, for example. Having a trustee that lives in L.A., for example, will create a tax issue from a U.S. tax basis. And then obviously the size and complexity of the trust is another factor. I mean, if we have a relatively small trust of a couple of $100,000 to a trust of millions of dollars, there's going to be a need for more complexity and more of an ability to understand the duties of managing that trust. I talked a little bit about conflict already in terms of the appointment of family. And I spent a lot of time in the last webinar about the appointment of family as a co-trustee or as a trustee. I think we all recognize that families with children with disabilities are unique, and that we understand that siblings are a vital component of family, and that, for the most part, those able-bodied children are unique in themselves. They're special. And we know that for many families, it is natural to consider the other sibling as a prospective trustee because we have trust in that individual. I think where the implication of conflict arises, where that sibling is also not only as a trustee, but they're seen potentially as an ultimate beneficiary of the trust fund. That creates a potential for conflict where there may be some deemed incentive not to disperse the trust fund, because if I don't disperse, I'm now going to be the ultimate beneficiary of this trust fund. Now, I know that 99% of the time that doesn't happen. Unfortunately, I see the 1% where it does happen. So, I think it's important to recognize that there may be a conflict, but there are methods to overcome that. And maybe that's by appointing a joint family member or friend or a corporate trustee in addition to the sibling, so that you have some balance between the two. And then somebody brought up the issue of remuneration. Obviously, remuneration of trustees is important. I'm going to talk a little bit about compensation again a little bit later, but there are obviously remuneration issues that are relevant. Whether the remuneration is directly outlined within the trust itself or whether it's vis-a-vis legislation, and I'll touch on that in a little bit more. And then I think finally to recognize that, with this fiduciary duty of acting as a trustee comes with it great responsibility and the prospect for liability. If a trustee does not act prudently, they could be held liable personally. I think you had a question?
No, we were just saying, did you want a drink of water?
I'm good.
We forgot to offer you that.
No worries,
Sorry.
thank you. So let's now talk a little bit about the administration of the trust itself. So this is now the trustee acting and starting to administer. They've been appointed as trustee. How do I begin? How do we begin this very, very important role? So the first step is to recognize that the trust document itself is the key vehicle. You need to obey what the trust says. You need to comply with what is listed in that trust. You also have a duty to be impartial. You're not there to benefit yourself. You're there to exercise and fulfill the wishes of the settlor who created the trust. Your job is to ensure that those needs of that disabled beneficiary are met. And you need to balance that against any potential prospective beneficiaries. And so it goes without saying that you need to act, obviously, in the best interest of those beneficiaries. You need to exercise your discretion in a reasonable manner. And unfortunately, what is reasonable is open to interpretation. And that's the challenge. And the more guidance a trustee has around discretion and how they should exercise discretion in terms of making disbursements. So, for example, if you are saying that you would like your son or daughter to be able to take a trip, there needs to be some mechanism to ensure that the trustee understands that and that is aware of that. And we'll talk on that a little bit later when we talk about letters of wishes.
When you talk about impartiality, is there any support or does the legislation speak to, or is there any sort of checklists or anything that will help a trustee determine whether they are impartial at all? You know how sometimes somebody might say, I'm a very impartial person, when in actual fact they don't recognize it. Is there anything that's available? Would they seek some sort of support? Would it be set up by the settlor to guide them in determining what that might be?
So, the concept of impartiality is really a trust concept. And it really is embedded in the combination of common law legislation, the trustee legislation. And so a trustee has a fiduciary duty. That's the fundamental component. Their fiduciary duty is to the trust, is to the settlor, is to ensuring that the trust is administered in a manner that is considered not impartial, that it's for the benefit of that beneficiary. And so they're not to be seen as taking favorites and favoring, let's say, one beneficiary over another. That is really embedded in common law. And it's important for a trustee to understand that, when they are taking on these responsibilities, they may not make everybody happy. And so when they're exercising discretion, they need to exercise common sense. They need to be reasonable. And I find that it's absolutely important that a trustee understand and respect the need for guidance and seek guidance when they have uncertainty and not make decisions without seeking expertise so that they can exercise those duties fairly and responsibly. because ultimately a trustee has to balance acting impartial, acting reasonably, while at the same time protecting themselves against liability. And so there's no fine duty there.
Right.
There's no clear answer. And I think what I try to encourage trustees to do is act with common sense. If it sounds reasonable, to the general public, then it's probably going to be reasonable in the eyes of the court, and it's going to be acceptable. It's when you start to act, with a heavy hand, or you act unreasonably in the eyes of the public interest, that you create potentials for challenge. Just moving forward here, again, this duty of loyalty goes without saying. Your duty of loyalty is to, the settler and to those beneficiaries. The other thing that's really important for a trustee to recognize is that they have a duty to protect the trust information. So the trust itself, any sort of auxiliary documentation is considered privileged, and it's for the eyes of the trustee. It's not to be dispersed publicly. So they need to protect that, protect the confidentiality of the individual that created that trust. Trustees also have a big obligation in that they need to be able to invest those assets that are held within the trust. And not every trustee, I know even myself, as a lawyer, I don't have great investment knowledge. And it's important to understand that you need to delegate. And where you don't have expertise, that you go out and seek good advice. And that includes investments or legal advice or accounting or tax advice. Seek the directions that will enable you to do your job efficiently. And those are expenditures that are considered reasonable to come out of the trust fund. So you don't need to pay these yourself. You can actually use the trust fund to pay for those costs, as long as they're seen as in the interest of ensuring that the trust is administered properly. So how does a beneficiary access funds to the trust fund? How do we work where we have a trustee and a disabled beneficiary, but we have such a trust, a discretionary trust, where the trustee controls all elements of disbursements? Now we have the strict interpretation, which is that the ministry says that the trustee must make those decisions without influence from the beneficiary. Now that's the strict legal interpretation. But in practical manner, a trustee will want to work with the beneficiary. They will want to seek input from the beneficiary on what their goals are. And so it is common that a beneficiary will make a request to the trustee, and then the trustee will exercise discretion, whether that fits within the terms of the trust itself, whether it's consistent with provincial disability benefit legislation, and whether there are any auxiliary sort of guidance that a trustee might have that might enable that trustee to make that disbursement for the benefit of the beneficiary. So there are not a lot of moving parts to this. And so from a practical standpoint, it's good to have good dialogue with your beneficiary. But we also want to be aware of the elements of risk. We don't want to jeopardize the interpretation of the trust. We don't want the ministry to think that in effect the beneficiary is controlling the trust and that the trustee is really more as a scribe for that beneficiary. But in practical terms, there is dialogue, there is collaboration. At the end of this presentation, there is an example of a standard requisition form that I find is used commonly with corporate trustees. And it's a requisition form that a beneficiary can complete, and effectively it keeps the trustee thinking about the categories of expenditures. So we talked early on about the list of permissible expenses. And I think it's important whenever a trustee is making a disbursement that they understand what category it fits in. And today the reality is, with the independence clause now being so broad, with an unlimited dollar amount, the independence area is commonly where many expenditures are classified. But that doesn't mean that, it could not be for medical equipment or for caregiver costs or housing or schooling, etc. With a discretionary trust, again, ultimately that trustee, remember, will determine whether that request is going to be granted or denied.
So what if the beneficiary does not have the capacity to ask on their own behalf? Is that where a representative for a representation agreement could act on their behalf? Would it be a committee? Would a caregiver have the capacity to be able to make those asks?
Yeah, and so, clearly where an individual does not have capacity, and that is a common situation, where does the collaboration come? And so definitely a Section 7 representation agreement is a vehicle. A committeeship as a last resort is an option. There may also be some clear guidance again from the parent, the settlor in this case, who created the trust, because they will know and understand their son or daughter, and perhaps they will provide some guidance as well, in addition to potentially some sort of a representative. But it's really important that whether or not that individual has capacity, that they be seen as having some voice, and that their needs are met and at least taken into account. And I think that's why, this whole concept of relationship with trustee is so important, and why it's important for your trustee to know the person with a disability. If they suddenly get into this role and they've never had a right relationship with that person prior, it's challenging for them to start making decisions without some guidance. So the more, I think, support around that person with a disability, not that we want a lot of cooks in the kitchen, but we want to have the ability to collaborate. And ultimately, the goal here is, let's ensure that your son or daughter, their best interests are at stake, and that you've taken steps to ensure that there's a network around them, to ensure that they're supported in decision making, and that you've got a trustee that is able to take on that responsibility, and that they've got enough guidance from you to make decisions that are going to be in the best interest of your son or daughter.
That's really helpful, because there was a comment. It's not necessarily a question that just says that this assumes that the beneficiary can complete the form, but everything that you've said is that there can be supports in place.
Absolutely.
Caregivers can support that, parents, family members, friends.
And I'm going to talk a little bit about the passing of accounts later on, because a trustee, they also have a duty to the beneficiaries. Whether or not that beneficiary has capacity, their accounts need to be vetted in some manner, whether it's informally or formally through the court. So we'll touch on that a little bit more, because that's another important checks and balance on the trustee. So again, a trustee, although they're going to consider this request, they're not obligated to say yes. But, a good trustee will work with that beneficiary, and an even better trustee will try to work on a budget, so that we anticipate what the expenditures might look like for the year, what types of expenditures might be covered from provincial resources, such as home care, CLBC funding, or home care through CECL or other agencies, and any other benefits that might be eligible through the ministry. So your trustee is going to be a strategic advisor as well, and working on a budget that will ensure that there are funds available throughout the year, but also that there's a provision within that budget to deal with unexpected events. And that will enable, I think, both the trustee and the beneficiary to work collaboratively because now there's some certainty. So it goes without saying that when you're creating these trusts, and I think I've emphasized this now several times, when designing the trust, ensuring that the wording in that trust accommodates some of this flexibility is vital, and it's going to ensure that the trustee's job is that much easier. So we've talked a little bit about a letter of wishes, and I find that in my practice that I commonly suggest that when we're creating a trust, the legal language is obviously in that trust, and we do our best to enable the trustees to have a good foundation of knowledge within the trust itself to ensure that they understand what they can and cannot do. But we also recognize that that trust has limits, and it may not provide all the answers. And I find that having worked with many trustees, they thrive on knowledge. They want to know what your expectations are of them. And so the more information, the more knowledge they have, the better they can do their job. And yes, families will obviously sit down and communicate with their trustees, have verbal discussions, maybe ongoing discussions annually, updating those trustees on changes, and hopefully your trustee is a part of that person with a disability's life. But what I find is very helpful is to put it in writing as well. So if you have certain wishes that you want your trustee to be aware of, and you haven't had the time to have some verbal discussions, why not address those issues in a letter to the trustee outlining what your goals are with this trust fund? Now, those wishes are not binding, of course, on your trustee, but they are highly influential. And it's important, I think, to remember that, again, trustees are looking for guidance, especially if they don't have significant knowledge about your child's, your son or daughter's needs. And so I find a letter of wishes is a great vehicle. Again, with its limitations, that it is not a binding vehicle. And I would suggest even having that letter of wishes somehow attached and available to your trustee, and even updating it on a regular basis, as the trust will be set in stone perhaps for many years, but the letter of wishes can change at any point, and because it is an informal document.
I had written on my notes when I was looking through these that I love that. That I think is something that would be really appealing to families because I think appointing a trustee is a really difficult thing for them to do. And if they have things like this where their desires, their wishes for the well-being of their son or daughter is in writing, whether or not it's legally binding, if they've done their diligence in creating a trusting relationship with the trustee, this is another way of ease their mind as they move forward, knowing that somebody else knows that.
And I think if those wishes are known, there becomes a stronger, although it's not binding on that trustee, it's influential, and it could be seen as an element of evidence if you have a trustee that, let's say, is not acting prudently, where you could bring those letter of wishes out and state clearly that this was the intention, and the intentions are not being followed. So again, I think it's just another vehicle that may be assistive to families in the overall plan?
So there's two questions online. One of them is, what if the expenditure is as basic as food? The PWD doesn't cover everything now. Many of us provide things like food. And so
That's a great question. And for years, I know that families, have always supplanted their children's, food and rent, for example. And historically, what families have done is they've purchased food cards. You might buy a Safeway or a Save-On card, and continuously provide that to your son or daughter. Um, for those that were a part of the March presentation, you'll know that the ministry, as part of their revamping of the legislation in December of 2015, also made some changes around gifting. And so they now recognize what we've all known for years, and the families out there obviously, that it's common sense that we're going to provide a fridge of food for our son or daughter. And why should our children be penalized? So gifting funds to your son or daughter is not considered something that will take away their benefits. Additionally, with the trust fund, though, when you're expending resources out of the trust fund, I think that's where a trustee needs to be creative. So you're not going to disperse the money out of the trust to the individual with a disability and then have them go out and purchase their own food. Because the challenge is, again, that the ministry will see that as unearned income. And again, unearned income is deducted dollar for dollar from your benefits.
I think that was the next question, actually, too, was this person was thinking about the requests for funds and currently now buy food every month. So how does that continue after she's gone, and how do they get to give her that food without it becoming taxed?
What I would recommend is that your trustee follow a process whereby they are either setting up an account at the local grocery store, whether it's purchasing gift cards, letting your son or daughter use that gift card as the vehicle to purchase food. So actually spending dollars for the purchase of a gift card, a food gift card, is seen as an indirect benefit and therefore not seen as unearned income, and your son or daughter will not lose benefits. So it may be simply as, it might be the representative. If that person, let's say, doesn't have capacity, maybe you're directing those gift cards to your representative under a Section 7 agreement or a committee, and then that individual goes out and assists the person with capacity challenges in purchasing food. So I think the key element here is indirect distributions. So the trustee is not providing direct dollars, although they could. They could conceivably purchase a gift card and hand that over to the person with a disability, and we'd be okay.
Right, okay.
Okay. I want to just touch on two other important elements of the trust. Again, a bit of a repeat from the March seminar, but with a true discretionary trust, there are two elements of these trusts that are vital in the drafting. The first one is that there must be what we call an ultimate beneficiary. So you have your disabled beneficiary, but for the trust to be deemed discretionary in the eyes of the ministry, there must be another beneficiary named, so that if your son or daughter should pass away and there are still funds within that trust, there needs to be an ultimate beneficiary. So that may again be a sibling, it may be a charity such as FSI, or another entity. And so there's opportunities there to name a beneficiary. But if you don't have that named beneficiary as an ultimate, the ministry will actually see that trust as collapsible by the disabled beneficiary. And a collapsible trust in the eyes of the ministry is not discretionary, it is non-discretionary, and therefore you are now limited to $200,000. So in drafting, it's absolutely vital that you have an ultimate beneficiary beyond your son or daughter to ensure that the discretionary nature of the trust continues. And many lawyers may not understand that distinction. And that's where having the disability benefit knowledge as well as the trustee and estate planning knowledge is vital.
And so I think that should answer the question that came in at the very beginning.
Yes.
What happens to the trust when the beneficiary dies?
And then the other important element is that commonly when we have two beneficiaries, so where we have a disabled beneficiary and then our ultimate beneficiary, trust law says that the trustee has a duty to both beneficiaries. They have an equal duty, or what we call an even-handed duty, between the disabled beneficiary and the ultimate beneficiary. Now I know that when I'm planning these trusts and we're creating an ultimate beneficiary, we're creating that ultimate beneficiary because we want to ensure that it's discretionary and it complies with the rules of the ministry. And so what we also do is we want to give the trustee that flexibility, because the intention here is to benefit your son or daughter, not necessarily the ultimate beneficiary. And so what I also encourage in the development of the trust is that the trustee be able to do away with the even-handed rule, that they can actually disperse the funds for the benefit of the disabled beneficiary without consideration for the ultimate beneficiary. And that is very important, because if that exemption is not permitted, then your trustee is in a bit of a bind. They now have this ultimate balancing act where they need to balance between the two. And that may not have been the intention when the trust was created. Any other questions on that?
If your child has no siblings, can a cousin's child or children be named? So that's if your child has no siblings.
Ultimate beneficiary?
So the question you're asking as the ultimate beneficiary.
It can be anybody. I mean, It can be an individual.
Yes.
It can be a charity. It can be a family member. It can be a friend. There is no limit. The key is that you have an ultimate beneficiary to ensure that you have a full discretionary trust.
Right. Okay.
Some other administrative points, I guess, that I'll just sort of highlight is, whether or not you want to put any restrictions on your trustee in terms of investments. Most people don't think about that when they're planning, but you can guide your trustee. If there is no guidance, the legislation will provide some guidance, and typically it's, again, very reasonable, prudent investments, especially where you have a trust fund that may have a long life. It's important that you manage it conservatively, ensure that it's got income, it's got capital growth. So ensuring, perhaps whether you want to have, a certain investment manager. Many families will work with advisors and may want that advisor to be engaged, and that's permissible, or any other advisor for that matter.
So the question is, does having an ultimate beneficiary avoid probate?
Well, that's a bit of a loaded question, because in the context of the trust, if it's pursuant to a will, if the trust is actually created pursuant to your will would have gone through probate, because your administrator would have had to have legal authority to be able to manage your trust fund. If, however, we have, let's say, a trust fund that is created outside of a will, let's say an alter ego trust, and you now pass away, there's no need for probate in those situations, because that is a private trust agreement. So it really depends on how the trust originated. And probate would only be necessary if the trust was created through a will. Otherwise, there would be no probate issues. Now, there is another potential challenge, though, is that if you did not, let's say, have a list of ultimate beneficiaries, and there were still trust funds within that trust, and there were no other beneficiaries, and let's say the will did not provide for ultimate beneficiaries, then what we would have is what we call an intestate trust fund. And an intestate trust fund would then require some further administration through probate to ensure that a family chain of what the legislature has decided would be the proper distribution. So I think it goes without saying you want to have some certainty on the ultimate distribution. So there needs to be a mechanism to ensure that we don't run into a situation where we might have an intestate trust fund that now needs to be further administered, further probated in the future.
Is there another question you want to? We're okay?
Okay. The other, common question, Angela, that I get from many trustees and families, parents, is that, they want, one of the most fundamental components of planning for their children is ensuring that their child has a roof over their head. And I think it goes without saying, one of the first questions that I get is, can we have a house? Can we have a condominium? And so there are many methods in terms of condominium ownership. First of all, a person receiving provincial benefits is entitled to own their own home, and that's considered exempt. It will not eliminate their entitlement to benefits. But, there may be a situation where the person with a disability, let's just say, doesn't have capacity, could not manage a property, and it would not be prudent to put that property into their own name. And that's where, the trust itself might actually purchase the home and utilize it for the benefit of the person with the disability. So there are many ways that a home can be facilitated through a plan, but I think it's a very, very challenging area. And I know that I can spend probably an entire seminar just on housing alone. There are implications that we want to be aware of from a provincial disability benefit standpoint. We don't want the individual to lose their shelter component of $375, which I believe is the correct number still. And so strategically designing that is vital. But also, more importantly, it's thinking about the what ifs. Who's going to pay maintenance on that property? Who's going to upkeep that property? What happens if there's a special levy? Who's going to pay for it? How are we going to deal with day-to-day maintenance and repairs, modifications? So it really involves a lot of issues. I know that the PowerPoint says to beware of the $100,000 rule, and that effectively is just a reminder to families that your son and daughter that is receiving provincial benefits is now entitled to have up to $100,000 in their bank account and not lose their benefit. So, in addition to these other exempt assets, whether it be a trust fund, whether it be a vehicle, or whether it be a home, they also can have $100,000 in a bank account. And so it's important to understand those various exempt assets that are available.
So a question did come in, and it says, what if you have already bought a home with or for your child?
So if you've already bought a home for your child and it's in their name, so you've named that individual with a disability, then obviously they're now the legal owner. And once an individual is a legal owner, they control that property. And that may be fine for families that have children that could manage a property. They have capacity, and that they may not be seen as vulnerable, maybe susceptible. I think a lot of concern that I see with families is a fear that somebody else might come into the life of that person with a disability and take advantage of them because they are perhaps highly influential. Um, if there's capacity issues, then we have a real problem because if that person now owns that property legally and they are the last holder of that property, their estate will now dictate who receives that property when they die. And if they have no capacity, then how are they going to do a will? Some other administrative matters that are important, I think, again, in the design of the trust is, what if the beneficiary passes, your son or daughter? You may want to provide some provision in the trust fund to deal with final expenses relating to that beneficiary, such as funeral expenses. And I think this is a reasonable, perspective, because that person with a disability may not have funds available in their bank accounts to cover those types of expenses during their lifetime. And then, of course, once that trust is finalized, and let's say that there is a passing of that disabled beneficiary, then the trustee can now take some steps to distribute whatever's left to those ultimate beneficiaries, recognizing that they are going to have some responsibilities around tax, completing tax returns, getting clearance certificates. And so that kind of leads me into the next sort of area, which is the whole concept of tax returns, and ensuring that trustees recognize that just like you and I, Angela, trusts are legal entities, and they do what we do, including pay taxes, unfortunately. And the responsibility for managing the trust and the taxation elements is on the trustee. And recognizing that those trusts are considered separate taxpayers and need to file those returns annually. The one distinction between you and I, Angela, and a trust is that you and I file what we call a T1 return. A trust files what we call a T3 return. And whatever income is earned in that trust is subject to tax. Just like how you and I earn income and we're subject to tax. Much like us as well, a trust is able to deduct its income, or from its income, any sort of reasonable expenses that it incurs in managing that trust. And that's, again, why it's important for a trustee to keep really good records. So it used to be, when we were creating trusts, that we would focus most of our attention on preservation of disability benefits and protecting disabled beneficiaries against vulnerabilities and influence. And taxation was not really a big part of the discussion. It was there, we were aware of it, but it was not really an overriding concern. Unfortunately, in January of last year, 2016, the federal government introduced what we now call the Qualified Disability Trust. And this is not really any sort of a separate trust or a different type of vehicle. What a Qualified Disability Trust, I'll call them QDT for now to make things simpler, is that the income earned within that disability trust is taxed at graduated rates of the income, or of the beneficiary. And so this exemption of a graduated tax rate is only available to the QDT. And that's important because if we don't have the marginal rates of tax, which are typically in that 22% range, then we're stuck with the highest marginal rate, which is 47% on income generated. And so that's become a relevant issue for families that are now planning a disability trust because we want to be aware of the tax implications. And ideally, we would like to ensure that our trust, whether it's non-discretionary or discretionary, meets the federal requirements of QDT. And that's important from a tax perspective.
Are there specialist tax people that can help with the taxes and the filings? And then, well, we'll deal with that one first. Yeah.
Sure. I think just like there are lawyers with expertise around disability and trust, there are definitely advisors that understand disability and trust. And it's absolutely vital that families work with an advisor that understands these elements. And I think, it starts with your lawyer, ensuring that you understand what the restrictions are of your trust. But it's even more important because your accountant is going to have the day-to-day annual involvement. And a lawyer will set this up for you, and you may not see them again for many, many years. And so having your accountant work with you and understand QDT, understand trust responsibility, and trust accounting is very important.
The second question was, is paying for a car or a renovation considered income in the hands of the disabled person?
So I'm assuming, again, it's from the trust itself. Again, if the funds are paid out of the trust fund indirectly for these two purposes, there is no loss of benefits. Again, it's indirectly going to the renovation or indirectly to a vehicle. Now, with the vehicle, the trust itself may not own the vehicle, but what you might do is you might go out and purchase a vehicle using the trust fund, and then that individual might become the owner. And so what you've got now is an asset that is being dispersed to purchase a vehicle and then immediately perhaps transfer it into the name of the person with a disability. That is now considered an exempt asset because it's one of those exempt assets under the ministry. Getting back to the QDT, there are criteria, and this is where it gets a little bit tricky. So one of the first important elements of a QDT is that there must be what we call an electing beneficiary. And the beneficiary of the trust must, not may, but must qualify for the disability tax credit, which is a federal tax vehicle. And so the families out there will understand that there's a distinction between provincial disability and federal disability. And unfortunately with government generally, they don't speak the same language. And so what is considered disabled in British Columbia may not be considered disabled federally. To enable you to have QDT status, which again is lower marginal rates of tax, the disabled beneficiary must qualify for the DTC in the taxation year and every year thereafter. So if one year you qualify and then the next year you don't, you suddenly don't have a QDT. So that is a big challenge, and I think we all know that we have children out there that might qualify provincially, but may have a challenge federally. And this has created some real challenges because there are disabilities where historically the federal government has not fit within the DTC. And that's now problematic in terms of the trust being able to be declared QDT. The other thing is that the trust itself must have a named beneficiary. So it must actually name the person with a disability, and that person must then be eligible for the DTC. And the other important element of the criteria of a QDT is that it must be testamentary. It must be a death trust. So these trusts, a QDT only takes effect if someone dies and the trust becomes in effect. It won't apply to those living trusts that I spoke of at the very beginning of this presentation. The other important criteria is that the trust must be resident in Canada. It cannot be a foreign trust. And there must be a joint election with a qualifying beneficiary, which means that the person with a disability must also have the capacity to jointly elect that that trust is in fact a QDT.
And so could they have capacity of someone
Yes,
else, like
yes.
a rep agreement?
And
or
that would be
common
the other vehicle is,
Okay.
and I might add though, I mean, that's my theory, Angela. I have to be honest, I don't think that the drafters have gone that far in their
Okay.
thinking. I think there is a general belief amongst my estate colleagues that a representative under a Section 7 agreement would have that authority, and that it would be feasible in the eyes of Revenue Canada. Clearly, a committee would have that ability for sure.
So, if a trust pays for a car or a renovation for a disabled person, is the money used to pay for the car or the renovation considered taxable in the hands of the person? So I'm assuming this is that third party that we're talking about. The trust pays directly to the car or to the renovation.
No, definitely not.
Okay.
No, so that would be effectively a distribution. It's not considered income in the hands of that third party. It is a distribution from the trust fund for the benefit. It's an expenditure.
Okay. So then there's another, it's sort of a question, follow-up comment. So one of the qualifying factors, according to this person, is for the disability tax credit is mental capacity.
Yeah.
That won't suddenly improve. So, whoops, the computer skipped there. Sorry. So, there was a comment. That won't suddenly improve. So how would they ever lose their disability tax credit?
Well, I can tell you for an example, I have a disability. I have a neuromuscular disorder. And I've had it all my life, and I expect I will have it the rest of my life. But even I, in the eyes of Revenue Canada, need to be reapproved every 5 years. So the challenge is that although we all know there may not be improvement, unfortunately Revenue Canada and the bureaucracy doesn't quite understand disability yet. And so there may be some duty to continue to ensure that you are eligible, and so you may need to demonstrate on a regular basis. And again, it will depend on the disability. And, but from my experience, Revenue Canada has never given someone a carte blanche, indefinite DTC. There is typically some criteria. And I've even seen it with folks with ALS on a regular basis.
I actually knew someone who, for the disability tax credit, as an adult, qualified with severe sleep apnea because of the fact that it was impacting their day-to-day life, and it actually didn't have anything to do with mental capacity. It had to do with impact on day-to-day life. Similarly, I've seen people get the disability tax credit with different forms of arthritis that are debilitating from day to day. So, sorry, there's another question, and that is, what expenses from a trust are tax deductible and which are not?
So first of all, and I think that's more of an accounting question, but generally, any sort of cost that's dispersed for the benefit of a trust is going to be deductible. So, if you're, for example, needing to have legal advice because you don't really have a good knowledge around disability benefits, you may go out and retain the services of a lawyer to provide some guidance on ensuring that you're aware of any updates, any changes in the legislation. That is considered a reasonable expenditure and deducted from the income that a trust might earn. Another expense is, the cost of financial advisors, whatever fees you're paying, bookkeeping expenses, accounting expenses to ensure that you're filing your T3 returns every year. Those are all considered reasonable expenses. The Trust Act, as well as the trust itself, will also outline what is reasonable. And so you'll want to be guided by that in interpreting what is reasonable. But again, it's a common sense approach. If you're managing a trust, there's an understanding that you're going to delegate reasonable things to individuals that have more expertise than you do. So I want to just get back to the QDT again, and just also the other important element to remember about QDT in terms of all those criteria is that you can only have one QDT trust, and so you're limited. And so, and this is becoming common where, if you have multiple trusts, you want to ensure that you choose the trust where making a QDT will be most advantageous. And so typically it's a trust where there's the greatest potential for earnings and where that marginal rate of tax will benefit. So it's important to recognize that you're limited to one QDT.
And so that is the person with the disability is limited to one QDT, not to the person who's setting it up. So if it's a parent who has two children, both with disabilities, yes, they can set up two separately, one for each.
Absolutely, absolutely. Now, if you don't meet these criteria, there are serious implications, and we call these recovery tax implications. And effectively, what it means is that if at any point your trust is not QDT, CRA or Revenue Canada is not very forgiving, and they will effectively treat that trust as without QDT, and therefore they will automatically assess it at the highest marginal rates. So it's absolutely vital that the trust be and remain QDT for it not to have these recovery tax implications. And understanding that if your beneficiary doesn't have eligibility for DTC, or the trust ceases to be a resident, or a distribution is made to a non-QDT or a non-disability tax credit beneficiary, you now have recovery tax. Unfortunately, there's no relief in the legislation. So if you're late in filing your election, Revenue Canada says, too bad. We're gonna tax you at the marginal rates. This is relatively new, and it's very strict. So, it's absolutely vital that the trustees understand the importance of some of these criteria.
So there is a question that comes in, and it says, I guess it's a clarifying question. So you can have more than one trust per child? Yes or no?
Absolutely. You can have multiple trusts. I guess, the common response is, what is the practical impact of that? You've now multiplied the number of administrative duties. You've got now trust returns. You've got multiple trustees. So yes, in theory, you could have multiple trusts, but from a practical standpoint, you want to create more bureaucracy. You want to create more work, and I guess by default, more expense.
So then there's another question. Can a trust have multiple settlors? So for example, an aunt or sibling leaves money. Can it be put into the QDT trust, or is it considered a separate trust?
So anybody can be a settler, and you can have multiple settlers. Whether that trust is QDT will depend on some of the criteria that I've outlined. So as a planner, there are some strategies that we'll look to. And number one, we'll look to ensure that there's a person with a disability as the primary beneficiary, to ensure that there is no recovery tax. We'll want to ensure that there is the ability for that electing beneficiary to be eligible for the DTC, ensuring that there is only one trust. And so when we're dealing with multiple trust situations, we're going to want to analyze which trust might be most advantageous to take advantage of that QDT. Capacity, again, to elect to be a QDT, and where that capacity is not evident, then contemplating alternate representatives through a Section 7 representation agreement or a committee where you have a guardian appointed. Now, one final responsibility of the trustee from a tax perspective is, again, the need for that trustee to apply for a final clearance certificate from Revenue Canada when the trust is wound up. And this is basically a document that the Revenue Canada provides that tells the trustee that all the taxes that are due and owing by that trust have been paid, and that the trustee is no longer liable and responsible, and that it's okay for them to now wind up the trust and disperse those funds to those ultimate beneficiaries. Not having that clearance certificate is a risk for a trustee, because if they don't have a clearance certificate and they disperse to those ultimate beneficiaries, and now there are no funds left to deal with Revenue Canada's tax duties, the trustee themselves might now be responsible personally for those taxes. So there was a question earlier tonight about sort of this obligation of the trustee and the duty to account to the beneficiary. And this is where your trustee is performing the administration of the trust, and at the end of the year, their accounts need to be approved. We need to vet and ensure that they've acted prudently, that their expenses are reasonable. And so that accounting and that duty is traditionally due to the beneficiary, the person with a disability. And, much like any other accounting report, there's a format. There's a format of how those numbers should look. There should be an accounting that provides a description of the assets and liabilities at the beginning of the accounting period, and then a list of all the receipts and disbursements made during the period, and then broken down into what we call capital and income transactions. And so the beneficiary needs to see that. They need to know that those are reasonable expenditures and that they can understand that accounting because ultimately they're going to approve that. Um, the trustee's remuneration is also going to be incorporated in that accounting. And I'm going to talk in a moment about remuneration. Now, generally speaking, when a trustee is producing an accounting, it's an informal process. The beneficiaries traditionally have the ability to vet and informally approve. And so when those accounts are presented, the beneficiary can then agree to those or disagree. If they disagree, then obviously we need to go to court to have those accounts approved by what we call the registrar of the Supreme Court of British Columbia. That's a costly process, and it's not something that we want to commonly do. And so there's a duty, I think, for trustees and beneficiaries to work together, and ensure that we're being reasonable as well. And the court will expect that as well. And if you bring a matter to the court and one of the parties, whether it be the trustee or the beneficiary, is not acting reasonably, the court will come down hard on you. So, this is obviously important in terms of not only Revenue Canada, the beneficiary, but also the ministry in terms of summaries and ensuring that you're accountable to all these parties and ensuring that we're making disbursements that are permitted and that are acceptable under the eyes of the ministry. And so where it becomes challenging, though, is where that beneficiary does not have capacity and they cannot approve their accounts informally. And so where there's capacity issues and where there is no representative or no committee able to approve those accounts, then unfortunately we have no choice but to have those accounts vetted by the Supreme Court of British Columbia. And so that's where we end up creating more cost because there's a cost then to provide, that sort of accounting to a registrar. Typically, it would involve lawyers. And so at that point where we have regular passings of accounts and we're creating that type of expenditure, that may be a point where we start to contemplate whether a committeeship might be more efficient and getting someone that can be a committee to be able to act as a guardian to approve those accounts in a more efficient, economical manner. Yes, there's a cost to having a committee appointed, but it's a one-time cost, and it may, over the length of that trust fund, provide some savings to avoiding unnecessary passings of accounts. So these are kind of the practical, real-world dilemmas that trustees face, and I think it's important for not only trustees but families to understand these elements of responsibility that a trustee has, and it acts again as a checks and balance, especially where we have vulnerable beneficiaries that are subject to the control of a trustee. We want to have these embedded controls that are in place to ensure that the trustee is acting prudently.
Right. Well, and I know some people who are online may be wondering about committeeship versus a representative agreement. And I know we had talked about possibly doing another webinar down the road about the pros and cons of those, because there are often questions around the strength or structure of a representation agreement and the control that might come with comiteeship. And the truth is there's risks associated with comiteeship that people need to know about as well that could take us a full webinar of 2 hours just to think about it.
And that's a great idea, Angela. I think that could be a future session for us. And, I might even suggest that we encourage folks from the public guardian and trustee to be a part of that. And, it's an area that I find is growing I guess, in our community. I think we're talking more about comiteeship. I mean, I think, again, and I shared this at the last webinar, that, I think comiteeship is a drastic last resource. And I think it should only be undertaken as absolute necessity. I don't think it should be utilized without a lot of thought. We are taking away someone's ability to make decisions, and we want to do that carefully, but we also want to recognize the cost of doing that and whether it's really necessary. And so we don't go out and get comiteeship just because it's something that is considered, what everybody else is doing. It's got to be necessary for your family and your son or daughter, and ensuring that, we have some clarity about why we're actually getting comiteeship. And so I think it would be a wonderful topic. And I know many of the families that I work with are, asking the question about comiteeship on a regular basis, and I think that it's a discussion that I'm sure many would welcome. Comiteeship, COMMITTEESHIP.
And one thing to note is anywhere you type it, it will always show up as needing spell check. Yes, it doesn't matter. It's not a recognized word in whatever computers you type it in.
So someone asked earlier about the issue of compensation for trustees, and I want to touch on that now because, again, it is important to recognize that, like other roles, trustees have entitlements to fees and compensation. Many times, and probably more so with corporate trustees and professionals, fees will be articulated in a fee agreement with that individual or that entity, and would be embedded and consistent with an index within the trust itself. But many times, compensation is completely silent in a trust, and there is absolutely no discussion of compensation. And so where do we go? How do we determine what is reasonable? Fortunately, in our province, we have what is called the Trustee Act of British Columbia, which actually outlines, and if you're looking at the sections, it's Section 88(1) of the Trustee Act, which provides for compensation for trustees for the time and effort that they spend in administering an estate. And there are several components to fees that families should be aware of. Initially, there is what we call a capital fee. A capital fee is a one-time fee that is based on the amount of the dollars in the trust fund when the trustee starts to administer that trust fund. The Trustee Act says that a trustee is allowed up to, and I use that word carefully, up to, not including, but up to 5% of the value, the capital value. Now that doesn't mean every trustee can go out and claim 5%. It's what is reasonable. How complex is that trust? I can tell you that most trusts are more in the range of 2 to 3%. 5% is at the higher end and would entail a very complex trust fund. So that's one component. The other component is there's an entitlement to a percentage up to, again, 5% annually, whereas the other one was a one-time capital, 5%, up to 5%. The other one is 5% on the income earned on the trust fund during the course of that year or the administration. Again, 5% is the high end. Doesn't mean you're going to get 5%, especially if you're not doing a lot of work in generating that income. So it's, again, what is reasonable. The third component of fees is what we call the care and management fee. And this is capped, again, in the legislation at 0.4%. And this is an annual 0.44% maximum that a trustee is entitled to for managing a trust throughout the year. So that's what the legislation says, and that is what is available to your trustee. Again, it doesn't mean that they get those numbers. It means that those are the high thresholds. They're going to get somewhere between 0 and one of those thresholds.
So I know we had talked before the presentation today, because I know this part is particularly complicated. Not that all of it isn't, because it all is. So one of the things we talked about was if the trust fund was $100,000, then the trustee, the capital fee, would be up to $5,000.
That's right.
The trustee only manages the trust and then they step down. You then are responsible for paying that one-time time and effort or capital fee to the next trustee and the next trustee, even if it could change monthly even.
Yes.
So I guess that speaks a little bit to the diligence of choosing someone and their commitment over time.
Yes, and I think, that's one of the dilemmas is that, that trustee fee is something that any trustee is eligible for. So if you appoint a trustee, they take their 5%, let's say, and then the next year they resign, and you need to go out and find another trustee, then you need to pay that 5% again.
Right.
So obviously continuity and knowing that your trustee is in it for the long haul, or as long as possible, is vital because you now have a $100,000 trust that's suddenly being eaten up by trustee fees and not benefiting your son or daughter, obviously.
So then the next part of that was the up to 5% on the income earned.
Yes.
And if we assume that the trust started at $50,000 and is now $100,000, so we've got $50,000 of growth
An income.
or in income, then that fee could be up to $2,500 annually.
Yeah, and I think we need to distinguish between, appreciation versus income, right? So, if you've doubled the value of your trust fund because you're just a very good investor, and it's not considered income, then that's a different thing. So it's income that's earned over that year subject to the 5%. However, the care and management fee of 0.4% would be based on the entire value. So not only the initial capital, but the additional gain in terms of investment appreciation. And so obviously that annual care and management fee is sufficiently less, but it also recognizes that trustees will have, performed an ongoing duty for the year, and there's some compensation that the Trustee Act says they're eligible for.
And so if there is no income or no growth,
right,
then or it decreases, then the trustee at that point gets nothing on that portion.
Exactly. Unfortunately, they don't get penalized on a loss. But, again, if they're not acting prudently in their investments, I mean, if they're going to Vegas, let's say, and betting it on black, that may not be seen as prudent.
Right.
And that may be seen as not dealing with your duties very reasonably.
Right. Okay.
So the other thing to note is that trustee fees may be subject to GST and will definitely be considered as income and taxable to the trustee. So if you're charging trustee fees, you're going to include it in your income. So if you have a full-time job and you're earning $50,000, and now you add trustee fees to that, you're obviously going to pay a high marginal rate of tax on that income. Now, the trustee is also, of course, as I've outlined before, entitled to be reimbursed from the trust fund for any out-of-pocket expenses. So if a trustee spends money to assist them in properly administering that trust fund, those are reasonable expenditures that trustee can be reimbursed. It goes without saying, professional fees, again, reasonable expenditures. I should add that, with corporate trustees, and I bring this up because obviously they're a group that is a lot more sophisticated in this area. And a corporate trustee will, when they're designing their fee agreements and when you're contemplating a corporate trustee, they are traditionally going to have some parameters around what the legislation will say. So, for example, with the one-time capital cost, they might actually stipulate in their agreements a certain percentage based on the asset value that they're going to administer. They also might have minimum fees. So I commonly see this with trust companies and banks where they may have a minimum fee of let's say $7,500 before they would even consider it, regardless of the value. So you want to read the careful fine print of those agreements and ensure that you understand what are the costs of engaging a corporate trustee. But also, when you're interviewing corporate trustees, I think it's so important because a lot of families now look to corporate trustees as a viable option for succession planning, that you understand clearly what it is that that trustee is going to charge, and that you understand what that fee might be, not only today, but 10 years from now. And being able to negotiate that today is important because if you're not here to be able to negotiate that, it's great to have some peace of mind to know that you've done that. But again, it raises that other point that you brought up. When you're interviewing that trustee, you want to talk about, a succession plan. You'll want to talk about maybe implementing, negotiating longevity, and ensuring that they're not going to renounce a year after getting into it. And perhaps designing parameters that will guide them in their responsibility. So it's a very important area, and I think I would encourage anyone contemplating retaining a corporate trustee to really do their diligence, ask a lot of questions, to interview several folks to get a sense of their knowledge around disability benefits and working with people with disabilities, ensuring that they understand disability as well and benefits. So I want to just talk about some final words of advice. Clearly, it goes without saying you need to gather the necessary information before you begin. You need to think about future events. Confirm your trustees' willingness to act as trustee. Don't just assume that they're going to be trustee. I think this session has really articulated what huge responsibilities a trustee has, and ensuring that they're really willing to act as trustee, and that they've hopefully attended this webinar, and if not, they've actually had a chance to view it on your website in the future before they act. And maybe this will be, a resource that they utilize when you ask that question, will you be the trustee for my son or daughter's trust? But before you take on that role, perhaps you might want to just understand what it means to be a trustee. And then finally, again, and I reiterate this again and again to families, ensure that you're retaining a lawyer experienced in setting up these types of trusts, but also ensure that they are knowledgeable about BC benefits legislation, and now even more so the federal legislation, and ask questions. Um, Hopefully, this session will provide you with a bit of a foundation to ensure that when you and your partners are looking at trustees, that you are asking the right questions, and you understand that acting as a trustee is a very significant role, and it's a big ask, and it's not one that you ask lightly, and that you ensure that your trustee feels comfortable in taking on that responsibility. There are a number of resources that are listed here. I would highly recommend them all as further sources of information. Um, in fact, I just wrote an article that is on the plan website that talks about some of the issues around choosing a trustee, and I find that those resources are going to be very helpful. And then the last PowerPoint slide, of course, is that trust fund requisition sample that I referred to earlier, and it might be a good source for families that have already got a trustee as a vehicle for actually administering that trust fund. Angela, thank you. Thank you, Fernando. A great honor to present to everyone tonight, and thank you all for listening for just over 2 hours.
Thank you so much, everybody. Thank you, Ken. Again, your expertise is amazing, and this is a complicated topic, and you talk through it with such grace and ease, and so we very much appreciate you being on here, and thank you to Fernando, and thank you to CLS, Community Living Society, again, for giving us their lovely space. It's still daylight outside, so we can still see the great view. And thank you to everybody for joining us, and it will be available online again in its entirety and in pieces. Before we sign off, I see Fernando waving. I just want to make sure, is there any questions we have not answered?